The financial planning process is the foundation of professional financial advice and provides a structured framework for helping clients achieve their financial goals. CFP Board describes the process as a systematic approach that integrates technical knowledge, communication, ethics, and professional judgment. Rather than focusing on isolated financial products, the process examines a client's complete financial situation and develops coordinated strategies to address needs, objectives, and priorities. The process supports both comprehensive and modular planning engagements and serves as the framework through which planners deliver advice across investment, insurance, retirement, tax, estate, and cash flow planning areas. Effective application of the process promotes consistency, objectivity, and client-centered decision-making. The first step is establishing and defining the client-planner relationship. This stage sets expectations and creates the foundation for a successful engagement. CFP Board requires planners to clearly communicate the services being provided, compensation arrangements, potential conflicts of interest, responsibilities of both parties, duration of the engagement, and any limitations affecting the scope of services. Establishing mutual understanding helps prevent misunderstandings and supports informed client consent. During this stage, planners also determine whether they possess the expertise and resources necessary to serve the client effectively. A well-defined relationship promotes trust, transparency, and accountability while ensuring both the client and planner understand their respective obligations. The second step involves gathering client data, including goals and objectives. Financial planners collect both quantitative and qualitative information necessary for effective analysis and recommendation development. Quantitative information includes income, expenses, assets, liabilities, taxes, insurance coverage, and investment holdings. Qualitative information includes attitudes, values, risk tolerance, family circumstances, priorities, and personal objectives. Comprehensive data collection allows planners to understand not only a client's financial condition, but also the motivations driving financial decisions. Accurate and complete information is essential because all subsequent analyses and recommendations depend upon the quality of the data collected. This stage also helps clients clarify and prioritize their financial goals. The third step is analyzing and evaluating the client's current financial status. During this stage, planners examine collected information to identify strengths, weaknesses, opportunities, and potential risks. Analysis may include evaluating cash flow patterns, debt levels, insurance adequacy, investment performance, retirement readiness, tax efficiency, and estate planning considerations. Financial ratios, projections, and scenario analyses are commonly used to assess financial health. The objective is to determine whether the client's current financial situation supports stated goals and to identify gaps that require attention. Thorough analysis provides the foundation for developing recommendations that are both realistic and aligned with the client's circumstances and objectives. The fourth and fifth steps involve developing, presenting, and implementing recommendations. Based on the analysis, the planner formulates strategies designed to help the client achieve desired outcomes. Recommendations should address identified needs while considering the client's resources, constraints, risk tolerance, and priorities. Presentation of recommendations requires clear communication, allowing clients to understand alternatives, benefits, risks, costs, and trade-offs. Once the client selects an appropriate course of action, implementation begins. This may involve opening accounts, modifying investment allocations, purchasing insurance, revising estate documents, or adjusting spending and savings behaviors. Successful implementation transforms planning concepts into actionable financial strategies that advance client goals. The final step is monitoring and reviewing the plan. Financial planning is an ongoing process rather than a one-time event because client circumstances, economic conditions, tax laws, and financial markets continually evolve. Monitoring allows planners to evaluate progress toward goals and determine whether adjustments are necessary. Significant life events such as marriage, divorce, career changes, retirement, inheritance, or health concerns may require revisions to the financial plan. Regular reviews ensure recommendations remain relevant and effective. This continuous process reinforces the planner-client relationship and helps clients remain focused on long-term objectives while adapting to changing circumstances and emerging opportunities. Financial statements are among the most important tools used throughout the financial planning process because they provide a structured representation of a client's financial condition. The two primary personal financial statements are the Statement of Financial Position and the Cash Flow Statement. The Statement of Financial Position, often called a balance sheet, summarizes assets, liabilities, and net worth at a specific point in time. Assets may include cash, investments, real estate, retirement accounts, and personal property. Liabilities include mortgages, loans, credit card balances, and other debts. Net worth is calculated as assets minus liabilities and serves as a key measure of financial health. The cash flow statement measures financial activity over a period of time by tracking income and expenses. Sources of income may include wages, bonuses, investment income, business income, and government benefits. Expenses are categorized into fixed, variable, discretionary, and tax-related obligations. By analyzing cash flows, planners can identify spending patterns, evaluate savings capacity, assess debt management practices, and determine whether financial resources are being used efficiently. Together, the Statement of Financial Position and Cash Flow Statement provide essential information for evaluating financial strength, establishing goals, developing recommendations, and monitoring progress. These financial statements serve as the analytical foundation upon which effective financial planning decisions are built.